6 Investing mistakes the ultra-wealthy don't make. The ultra-wealthy, also known as ultra-high net worth individuals, UHNWIs, are a group of people with net worths of at least $30 million. The assets that make up their net worth include real estate, personal investments like art, cars, and planes, as well as stock in both private and public companies. Many people with lower net worths think that the secret to becoming uber-wealthy is some hidden investment plan when they observe these UHNWIs. This isn't typically the case though. Instead, UHNWIs know how to take sensible risks and are familiar with the fundamentals of making their money work for them. In the words of Warren Buffett, the #1 investing rule is not to lose money. UHNWIs aren't mystics, and they don't harbor deep investing secrets. Instead, they know what simple investing blunders to avoid. Many of these mistakes are common knowledge, even among investors who are not particularly wealthy. Here is a list of the biggest investing errors UHNWIs avoid making. 1. Only investing in the US and the EU. UHNWIs look outside their borders to frontier and emerging markets even if industrialized nations like the United States and those in the European Union are considered to offer the best investment security. The top nations where the ultra-rich are investing are Singapore, Chile, and Indonesia. Individual investors should, of course, investigate emerging markets and determine whether they fit within their entire investing strategy and portfolios. 2. Investing only in intangible assets. Stocks and bonds are typically the first things that come to mind when people think about investing and investing techniques. These investments are not always the greatest, regardless of whether this is because of greater liquidity or a lower entry cost. UHNWIs, on the other hand, are aware of the value of tangible assets and allocate their funds accordingly. Individuals who are extremely affluent often invest in assets like land, gold, private and commercial real estate, and even works of art. To offset the volatility of stocks, real estate remains a popular asset type in their portfolios. Even though it's crucial to invest in these tangible assets, smaller investors frequently steer clear of them due to their lack of liquidity and greater investment costs. However, according to the ultra-wealthy, ownership in illiquid assets, especially ones that are uncorrelated with the market, is beneficial to any investment portfolio. These assets aren't as susceptible to market swings, and they pay off over the long term. For example, Yale's endowment fund has implemented a strategy that includes uncorrelated physical assets, and it returned an average of 10.9% per year between June 2010 and June 2020. 3. Allocating 100% of investments to the public markets. UHNWIs are aware that actual wealth is created in the private markets as opposed to the open or general markets. Many ultra-wealthy people get their early wealth from private companies, frequently by becoming business owners or angel investors in private equity. Furthermore, elite endowments, like those managed by Yale and Stanford, invest in private equity to boost returns and diversify their portfolios. 4. Keeping up with the Joneses. Many smaller investors constantly monitor what their competitors are doing in an effort to improve upon or match their investment approaches. To grow personal wealth, it is essential to avoid getting sucked into this kind of rivalry. The really affluent are aware of this, and prior to making investing decisions, they set personal investment goals and long-term investment strategy. UHNWIs have a clear idea of where they want to be in 10, 20, and even more years. And they follow a financial plan that will get them there. They maintain their path rather than trying to outrun the competition or get anxious about the impending economic slump. Further, the ultra-wealthy are very good at not comparing their wealth to other individuals. This is a trap that many non-wealthy people fall into. UHNWIs stave off the desire to purchase a Lexus just because their neighbors are buying one. Instead, they invest the money they have to compound their investment returns. Then, when they've reached their desired level of wealth, they can cash out and buy the toys they want. 5. Failing to rebalance a personal portfolio. America has a serious problem with financial literacy, yet everyone needs to know how to rebalance their portfolios. Investors can make sure their portfolios are appropriately diversified and proportionally distributed by regularly rebalancing. Even though some investors have precise allocation objectives, they frequently neglect rebalancing, which causes their portfolios to bias too much in one direction. Based on a person's age and risk tolerance, a balanced portfolio typically contains the ideal ratio of cash, equities, and bonds. For those who are extremely wealthy, rebalancing is essential. All UHNWIs regularly rebalance their portfolios, whether it is on a monthly, weekly, or even daily basis. It is feasible to establish rebalancing parameters with investment businesses based on asset prices for those who lack the time to do it themselves or the funds to hire someone to do it for them. 6. Omitting a saving strategy from a financial plan. Being ultra-wealthy requires investing, yet many people overlook the value of having a savings plan. UHNWIs, on the other hand, are aware that a sound financial strategy involves both savvy investment and prudent saving. The extremely affluent can therefore concentrate on raising their cash inflows and lowering their cash outflows, which will increase their overall wealth. Although it may not be customary to conceive of the extremely affluent as saves, UHNWIs are aware that doing so will help them accumulate their desired level of wealth faster.